Endgame situation is the Fed having to buy treasury bills directly. The thing that people will notice on the ground is resource scarcity is going to start. And we're already seeing this, the LBMA is being drained of both gold and silver. I bet the other metals are being drained too. We're going to start seeing lumber scarcity. We're going to start seeing oil scarcity. Prices are going to start galloping higher. We might start seeing price controls as a response from the government. Everybody on Earth becomes a prepper overnight, Dunnigan, right? They all rush out to get whatever food and other supplies they can.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 10th through March 17th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold Krugerrand at just $59 over spot. Next, Valcambi silver kilo bars are just $2.20 over spot per ounce. Pre-65 mixed junk silver is just $1.99 over spot, and pre-65 half dollars are just $2.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this returning guest. Phil Lowe is the founder of the Bitter Draught, a new platform on Rumble, and he was introduced to us by our mutual friend, Rafi Farber. Phil, thanks for coming back on Liberty and Finance today, the 11th of March, 2025.
Great to be back on, Dunnigan. And it's also great to see the empirical evidence supporting all of our theories that we have been talking about for many years now.
Things are playing out rather dramatically in our financial world. There's certainly a lot of things going on. There's this flight of gold and now silver from the vaults of London, some heading towards the COMEX vault and then turning around and being delivered for physical right away on the COMEX, which is more deliveries in the last year off of COMEX than in its history. So it was never intended to be a vehicle for physical delivery of metals, but that's what it has turned into because people and countries and et cetera are grabbing their gold and silver. There's several topics that we were going to talk about together today. I wanted to run through those very briefly so that our viewers have a heads up of what to look forward to. Let me go there right now. And first of all, there's been a lot of talk, and we recently interviewed Dr. Judy Shelton, Trump's one of his former economic advisors from his first term, talking about the importance of the U.S. Strategic Gold Reserve, whether it still exists or not, et cetera, and what it should be valued at rather than the current ridiculous $42 or whatever per ounce. You have a explanation to give us of why the proposal that some have brought forward of a mark-to-market, meaning, well, at least we should be valuing it at, $2,900 plus or something to reflect the true value of it to the U.S., why that's doomed to failure, and why instead it probably won't happen before a panic, but more fundamentally, why a full gold revaluation is the only viable option. Very intriguing, because some people have projected that if you look back in history, as far as at times of turmoil and distrust, et cetera, and transition, the gold price rising to cover the entire currency supply would be rather astonishing at this moment, what that would mean in terms of nominal value per ounce. Also, you've talked about, and other Austrian economists have talked about a crack-up boom or a hyperinflationary panic. You want to talk to us about what are the clear signs of a hyperinflationary panic, when we'll know that it's a crack-up boom has started. And then related to that is how inflation, which is actually a policy of the Fed, we talked about that with Dr. Judy Shelton, why that even should be or shouldn't be, why inflation itself causes immoral behavior and societal degradation. Nothing good for our families, society, etc. So let's start at the top. Why you believe that a mark-to-market revaluation of gold, and it was rather mysterious when the Secretary of Treasury said in the Oval Office we need to re-monetize the asset side of the U.S. balance sheet. What that was referring to, a lot of people have theories about that, but you'll tell us why you believe it's doomed to failure to just mark the U.S.'s gold hoard to the current market price.
Yes, and I know what happened. I know Scott Bessent got in, and then he went and opened the books, and he said, "Yikes!" And then he closed the books right back and said, "We need to start floating trial balloons about marking things to market and selling off government land and things like that." So this is actually my most popular episode, is what happens on a gold revaluation, and I go into detail on my channel. It's episode 10 for those interested, but I will cover it here as well. When you understand what gold is, it is a note. When you understand what the dollar is, it is a note for gold at $42.22 an ounce. And it is an unredeemable note. So the conceptual way to think about this for regular people would be, if you have a coupon for a free burger at a local restaurant, and you go and you have it and you want to go redeem it, right? That equals, that this coupon equals this burger, right? But what happened in 1971, Richard Nixon closed the gold window temporarily, and we'll put that in quotes. And so if you have, once again, if you think of it, if you have that coupon and you drive to the McDonald's and you find the McDonald's, it's the McDonald's or the whatever burger restaurant, you find the burger restaurant is closed temporarily. Your coupon is, if the restaurant was shut down for good, right? If the restaurant said out of business, the owner died, we're moving, we want to go do other things, then you would say, oh, this coupon is completely worthless. But because the restaurant says closed for renovations, you hold on to the coupon. You say, you know what? The restaurant might open again someday. And so therefore, I'm going to keep the coupon, because when it reopens, I will go back to that restaurant. Now, that restaurant's been closed for 50 odd years and counting, but it is still theoretically temporarily closed. And because it's gold, the promise to reopen it's really a promise that's been pushed off to the indefinite or infinite future. So you can think of your a $50 bill roughly, or if you have $42.22, you can think of that as a redeemable note for gold in the indefinite, or in this case, infinite future. So in the end of time, when the last star twinkles out of existence and all that are left are black holes, you should be able to go down to the Eccles building and knock on the door and say, "Can I redeem my note now? Is that possible?" Now you won't be able to, because it is actually, in truth, it is completely closed, but mechanically it is temporarily closed. So the present value of gold right now is almost, I think it's $3,000 or $2,900, right? That represents gold right now. So you can hold on to your $42.22 and you can redeem that for gold in an infinite timeline in the future, or you can cash that in right now for the low price of $2,900, right? So it's just you can think of the $42.22 as the futures contract, and the present value of the gold right now of that futures contract is $2,900, right? So the gold, what people don't understand is that gold is the price matrix, right? In 1971, right before the gold window closed, a cup of coffee was 5 cents and gold was $35 an ounce. So a cup of coffee was 1/700th of an ounce of gold, right? Right now, gold is $2,900 and a cup of coffee is like $5-6 or something. And that is a small cup of coffee. And that is 1/1000th of an ounce of gold. I did the math a long time ago. It's about 1/1000th of an ounce of gold. So it's actually gotten cheaper in gold terms, right? So, but everything is still priced in gold through the dollar medium sort of interfering with us. But because the medium is fake and it cannot be redeemed, the things are getting very distorted. Let me put it that way. Now, because the books are getting worse and worse and worse at the Treasury Department, they're talking about a revaluation of gold. So what would happen if we revalued gold? So to revalue the dollar against gold is to reprice everything in gold terms. We're not just to just say, oh, we're going to revalue $42.22 to $3,000, and the Treasury is going to have $800 billion now on their balance sheet to play with, and nothing else will happen, is complete foolishness done again. That is not what's going to happen. If you revalue from $42.22 to $3,000, that means, if you go back to the coupon example that I was talking about, imagine if you go to the restaurant and the restaurant says, you know what? Even though that coupon says one free burger at our restaurant, we are repricing it. So now you need 10 of these. So you need 10 one free burger coupons to actually get a free burger at our restaurant, right? What happened to the value of that coupon? It was cut into 1/10 of its previous value. It is the same thing when you reprice $42.22 to $3,000, except that is a 71 times multiple. So if you were to revalue the dollar to gold from $42.22 to $3,000, the price of everything else is going to multiply very, very quickly by about 71 times. Now, we don't know exactly, what everything will be, because it's like the price matrix is like an ocean, right? There's all these waves and everything's fluctuating, but we can roughly say it's going to be like the land of $3,000 revalued dollars to gold is the land of $250 gasoline. That I am absolutely certain in terms of order of magnitude, and that's the end game right there. I mean, no one can afford $250 gasoline. And so even the spot price of gold, we have to think about this, that the crisis isn't over at that point. That's not the end game. That's just the very start of the end game, because the price of gold at $3,000 at that point is the price of the infinite timeline. It's right at that moment when you revalue, it's also the price of today. So everyone's going to say, I can have gold at the end of time itself for $3,000, or I can have gold right now for $3,000. What are people going to do, Dunnigan? They're going to rush out and buy gold. So the present price of gold is going to absolutely skyrocket as well. Now, it will not go up 71 times because I have a very large budget, so I brought a prop, which is a rubber band here. So if you think of the $42 to $3,000 and the current price of $3,000, right? So as this stretches out, it risks snapping. Obviously, at some point, it's going to snap and there's going to be hyperinflation. So what they're talking about with revaluing is they say, we'll just revalue and then the rubber band will go slack and the tension is gone. That's not what will happen. When they revalue, the whole thing is going to move over here. Now, the slack, there will be a little bit of slack, but it's not going to be that much slack. So we can think of it in the dollar terms. We can think of the spot price of gold going up to, and I'm just spitballing here. We're talking orders of magnitude. There's no precision at all, but we're talking $30,000, $40,000, $50,000 for the spot price of gold. So, and like I said, this would absolutely start the crack up boom. So the other thing that I've heard discussed, and to be fair to Scott Bessent, I haven't heard him say this, is a partial revaluation of 25 to 40%. I've heard other people talk about this. I think it was Peter St. Onge on his YouTube channel was saying, we can just go to a 40% revalue of gold. That will also fail miserably. Redeemable or not, because if the gold is redeemable and it's 40% revalue, 40% covered, then everyone's going to rush to redeem the gold because there's only 40% backing it. And if it's not redeemable, then we're in the exact same problem we just were with mark to market. Only gas is now, $1,000, $2,000, $3,000 a gallon. So we're in the exact same thing. It's still the end game. And I know where the 40% comes from. The 40%, and this is all over the place, and it's in academic literature that you can back a currency 40% with gold and nothing bad happens. This only occurs on the way down. So all currencies always start 100% backed by gold, and then they start, people get greedy and they start degrading the currency. And I'll give another example, just to have people think about other things besides the monetary system, because the monetary system is often very complicated. So if you imagine you're the CEO of a Best Buy, or there is the CEO of Best Buy, and he's selling TVs, and everything's going fine, and then he realizes, we don't have to put a TV in every single box. So he comes up with this scheme where, 98% of the boxes have TVs in them, but 2% don't. And everyone buys it, and the unlucky people that don't have TVs in their box, they get home, they open the box, and there's just rocks in there. So they call customer service, and customer service says, well, you didn't buy our extended warranty plan, and getting a box of rocks is not covered by the plan and that you didn't buy. So sorry, no refunds, good luck. And for whatever reason, this actually doesn't, the word doesn't get out, and this actually works for a while. And so the CEO gets, well, let's chop it down a little lower. Let's see. And you can do this all the way down to about 40% before word gets out and people saying, hey, there's just rocks in these boxes. So word gets out, people start abandoning, they don't go to Best Buy to buy the TVs. And the few people that are still going, the CEO says, well, we need to make up for all the lack of customers we have now. So we're just going to cut it to 0. So every single box of TVs is just going to have rocks in it. And then, of course, very quickly, what happens? People just stop going to Best Buy completely. Nobody goes. And now the company's right at the verge of bankruptcy. So the CEO gets on Twitter or X and he says, listen, he makes a tearful apology video. I'm sorry. I shouldn't have done that, but we're going to make amends. And from now on, I swear as the CEO of Best Buy, my hand on the Bible, that 40% of all our boxes are going to actually have TVs in them, right? That's not going to work. That worked on the way down, but you can't promise that only 40% of your currency is backed and have it expected to work on the way back up when you're trying to redeem yourself, right? So this is the mark-to-market revaluation isn't going to work. The partial 25 to 40% revaluation will not work, whether redeemable or not. The only possible outcome is a full revaluation, which is going to be about $60,000 to $80,000 an ounce and counting. And it's the only thing that's going to put an end to the crisis is the full revaluation. Now, this will not occur before the panic, 99.9% certainty of that, because it's going to take an iron will to do a full revaluation before the monetary panic, right? The initiator of the revalue will take all the blame. If Scott Bessent, because what you're telling everybody is you're broke. So for Scott Bessent to do the revalue, or for President Trump to do the revalue, or let Bessent do the revalue, is to tell everybody, hey, guess what? These notes are worthless. And whoever does that is going to crash the entire world's monetary system, and they're going to take all the blame. So they're not going to do it before hyperinflation kicks in. And that's the crack up boom, which we are about to get into right now.
Now, just quick before we leave this topic, this $60,000 to $80,000 gold that you mentioned there, is that based on a calculation of the current currency supply, the number of dollars in existence versus the number of ounces of gold that the U.S. supposedly owns?
That covers the bank account, the checking deposits too. So that would cover all currency plus all checking deposits. Now, it doesn't cover debt. So the treasury notes are still going to be worthless. The bonds, all corporate bonds are still going to be worthless, all that stuff. But that will save checking deposits and notes. If you just want to save physical notes, it's like $15,000. It's a lot lower. And maybe we'll do that because all the banks are going to go out of business anyway. But the problem is the people, it doesn't matter that much because, going from $42,000 to $15,000 an ounce or going from $42,000 to $60,000 an ounce isn't that much of a difference, but it is some difference. And so you're determining who the winners and losers, who's going to get that purchasing power. Is it going to be just the people with the physical cash? So like street musicians, or is it going to be, people with large bank accounts too? So I think they're going to try and save the people with bank accounts because that's most people.
If recent events are any indication, Janet Yellen's move to bail out big depositors at Silicon Valley Bank, et cetera, Signature Bank, et cetera, even though it violated the Dodd-Frank Act, was indicative that there's a different standard that applies to the elite level of depositors than for the ordinary moms and pops. So I think you're right to include that as part of what's most likely in the case of a big traumatic reset. Now, you've mentioned about the phenomenon that Mises called a crack-up boom, a hyperinflationary panic, when suddenly, it's as though suddenly the crowd, which has had their eyes glazed over and veiled, kind of like the king of Rohan, when suddenly when somebody shouts, the emperor has no clothes on, and the little boy says it out loud, says the quiet part out loud, and everybody goes, oh! Now everybody knows that everybody knows. Then suddenly there's this rush to get rid of what we've all now acknowledged as worthless and quick grab onto something that's real. Can you describe to us that phenomenon and what will be the signs that it's starting to happen?
Sure. So everyone always asks when, and I'm sure you've gotten this. I know I've seen it in the comment section of my own channel and every other channel I'm on. Everyone's like, oh, these guys have been talking about this for 20 years. It never happens. They'll find something and we'll just kick the can down the road another 15 years. and no one can time it precisely, but there are very clear signs when a panic is forming. So the first sign is just no more debt can be accrued. You just hit this brick wall of debt. And so the interest rates are too high. People don't want to take any more debt. The banks are unwilling to lend at the rates there are, so rates are still going up, right? And just no more debt, and there's this big clog. And that's sort of when the bank seizures start happening, and you get into this deflationary crash, and then the Fed has to step in, right? So as a result, the yield spike, and the Fed starts to lower the federal funds rate. Now, the federal funds rate is just the overnight rate that banks lend to each other. It theoretically is supposed to, and has to this point, affected all the other interest rates. In the end game, like I said, no more debt can be accrued, so the interest rates start to go up. And the reason this happens is because normally the calculation of interest, when you're going to make a loan to somebody and you want to think about how much interest should I charge, there's three fundamental factors. One is how long do they need it for? Second is what's the risk that they're going to default and can't pay me back? And the third is how badly do I want this money? How badly do I need it now, right? So those are the three things. And this is what people calculate in a low inflationary environment. In a high inflationary environment, there's an added wrinkle. There's a fourth factor that banks and anyone loaning out considers. What will it be worth when you pay me back? So if inflation is galloping along at 10, 15, 20, 25%, and I give you a year-long loan for 10%, when I get that loan back, I'm poorer, even though I've gotten the 10% interest rate, right? So what I'm looking for the sign that the Fed has lost control. It's called the Fed has lost control when they slam down the interest rates back down to zero and start printing like crazy, but every other interest rate just keeps going up and up and up. And this is why people that are in adjustable rate debt right now are in a very dangerous position, because they think, oh, the Fed's going to start printing again and interest rates are going to go down. If this is the end game, that will not happen. So if you look at Argentina, they had inflation rates of 102%, annualized, and their interest rates, their 10-year yield was, 105% or something like that. It was keeping up with the inflation rates. So adjustable rate debt will bury you in when the end game hits and when it starts. And the kiss of death, what I'm really looking for the kiss of death is the Fed buying it all. So right now, I think, I believe, someone can correct me if I'm wrong in the comments, and they certainly will. I believe the Fed is not allowed to directly buy treasury bills. They have to go through the primary brokers. And I'm expecting, and I don't know, this may not happen as I'm envisioning it, but I think this is what's going to happen. I think the primary brokers themselves are going to get very leery of even being the conduit between the Treasury and the Federal Reserve, and be like, I don't know if we want these notes. And so if they change if it's a law, this may not happen. But because the law requires 2/3 of 50% of Congress and the president's signature, if it's just a regulation or some sort of tradition, then that's going to go straight out the window, and the Fed is going to start buying Treasury notes directly. And what happens when the Federal Reserve starts buying Treasury notes directly is the vertical money print, and we can see what happened by looking what happened in the early 1700s in France with the Mississippi bubble. So in the 1700s, this scoundrel named John Law sweet talked his way into the royal court and got the money printer. The king gave his joint, I think it was called the John Law Joint Stock Company or something like that, gave him the money printer, and they were issuing notes that were somehow loosely based on some land in Mississippi, which is why it's called the Mississippi bubble. So you'd get these, the debt was notes for land in Mississippi, and the currency was somehow backed by it was all Ponzi. It was just like this. It was a total Ponzi scheme. But theoretically, you were buying land in Mississippi, basically, and the currency was like related to it somehow. This scheme went on for a while, and actually people poured into it as they do to every Ponzi. Every Ponzi looks great when it starts. But they noticed a lot of the currency notes were flying around, and what happens? Inflation, prices start going up. So people said, "Oh, I'm I'm losing money and things are getting very expensive. I need to sell some of this this joint stock company. I need to sell these shares to get currency to go buy food because prices are skyrocketing. And so the price of the debt started to collapse. So the joint stock company, John Law, said, I have a brilliant idea. We will back these debt instruments by buying them at, whatever the market rate was, much higher than that, or whatever their face value was. So we will pay full freight for this debt. And that way we will instill confidence in people because they will know their debt is fully redeemable with us, the joint stock company. But that didn't work. What happened was people said, oh, this sucker is buying all this worthless debt at high price, at full freight. So all the debt flooded right back into the joint stock company. And the currency flew out and the currency hyperinflated. Now, why did that happen, Dunnigan? Because you cannot owe, the scheme does not work if you owe yourself the money, right? If I write myself a check for $20 million and I put it in my left pocket and I write the liability side and I put that in my right pocket, nothing happened, right? I cannot actuate on any of that at all, right? That money doesn't exist. However, if I can write a note for $20 million and get, or even let's say $2,000, if I can write a note for $2,000 and get someone else to take it, now I have started a scam, right? Now I have started something. So when the Fed buys its own debt back, it's taking debt in the units of its own currency and putting it in its left pocket and the notes in its right pocket, right? You don't owe yourself anything. And so the whole scheme collapsed. That will be the kiss of death. I think it will happen. It might still go through the prime brokers. Like the prime brokers might still act as a conduit, but they even though everything is mouse clicky, it's mouse click fast, because this needs to go vertical, that might still be too slow. So what I'm looking for the real kiss of death, like, cats and dogs living together, horses riding people, Endgame situation is the Fed having to buy treasury bills directly. And so the last thing, the thing that people will notice on the ground is resource scarcity is going to start. And we're already seeing this, the LBMA is being drained of both gold and silver. I bet the other metals are being drained too. We're going to start seeing lumber scarcity. We're going to start seeing oil scarcity. Prices are going to start galloping higher. We might start seeing price controls as a response from the government. I think it's unlikely in this administration, but it is possible. And so the point of view of the average person, the crack up boom has 3 phases. And in the first phase, people actually hoard dollars as the prices gallop higher in an attempt to maintain their lifestyle. So the first thing every family does, you cancel ballet class for the kids, you cancel the ski vacation, you sell the RV, you do whatever you need to do to keep the lights on, keep your kids fed, keep the basics going, right? That will fail to keep up with inflation because at the end game, inflation is going to be galloping higher. When that fails to keep up with inflation, people suddenly realize that the prices will not stop going up and they all rush out to buy necessities in bulk to save their wealth in real goods. So they stop trying to do savings, and I covered savings and investment on our last interview. They stop trying to do savings in the money good and the derivative of the money good, and they start trying to do savings in direct good. Everybody on earth becomes a prepper overnight, Dunnigan, right? They all rush out to get the whatever food and other supplies they can. And of course, this is very late in the game, and all the people that have prepped before are, sitting back and, open up a cool on their lazy boy while, Walmart is, being pillaged. Now, as the panic reaches the fever pitch, this is after the store shelves have been cleared, and people dump their currency on literally anything, hoping to find someone who will take the currency for whatever items are left. So now, and I remember this story from a story I heard from North Korea when their currency hyperinflated, I think in the late 90s or early 2000s. These parents took their life savings and their, the North Korean notes and gave it to their daughter and said, go get something. And she came back with a tracksuit on. Now this tracksuit, it was basically the entirety of their parents' nest egg, had bought their tracksuit. So the whole family's sobbing and she's swearing she's going to wear, she just said, I'll wear this tracksuit forever. It's the most precious thing, because the parents sacrificed everything in order to get her just, whatever she could find. That will be the final step where it's not even like I needed a tracksuit. It's just, I need to dump this currency and put it into something else so that I can either keep the thing that I have or trade it, trade it along the line, right? So once the currency is completely dumped, once it's littering the streets and nobody will bother to pick it up, then people can start rebuilding their savings anew. And it'll either be, the government will say, oh, we're really sorry we did that. Full revaluation to gold. We'll build new credit notes on top of that. Or if the government doesn't want to do that, people will just trade gold, silver, copper directly, and private banks could issue private bank notes on top of that. So we will rebuild anew. But this crack up boom must occur. It is inevitable.
You mentioned also how inflation drives immoral behavior and societal degradation. You just described some imprudent, you can't even call them investments, just trying to just dump anything, any port in a storm. In other words, if your storm is financial, then anything physical, anything tangible is better than having something that's just recognized universally as worthless. So people would be dumping the currency to get into anything tangible or intrinsically valuable. But why does inflation also along the way drive immorality and societal degradation?
Sure. So if we look, and I invite the viewers to look at pictures of Weimar Germany, and you will be shocked at how eerily similar it is to today's society. I mean, you'll see, what look like fourth wave feminists, burning bras and stuff like that, and dancing provocatively on stage. And you'll have cross-dressing, widespread cross-dressing, and just pure hedonism mixed with, extreme poverty. Like you can see people already in Weimar, struggling to get food, spending their day's wages on a lump of coal, all that kind of stuff. And the two kind of meld into each other as everybody is just trying to live for today. And the other thing you'll notice, the other thing you can see is I have to choose my words very carefully now, Dunnigan. The solution to Weimar was not the correct solution that the German people came up with. I am in no way advocating for that solution to Weimar. But if you look at what was happening in Weimar, for example, the book burnings, when you find out what books they were burning, you say, oh, it was not Catcher in the Rye. It was not Mark Twain. It was these bizarre sexual books written by this Magnus Hirschfeld in this sexual institute that he made in Weimar. And it was all the stuff that parents are complaining about now in school board meetings. It was books about cross-dressing. It was books about LGBTQIA plus stuff. And it was books about, what should be the real age of consent. It was all the stuff that people get upset about. And so you say, wow, that happened back then. Now, again, I stress, I believe in freedom. I don't want us to go down a socialist route. And national socialism is just as bad as global socialism. But we have two data points right here that highly inflationary societies lead to immoral behavior. So now the question is why? So my theory, and this is just me thinking about this over the past 5 years, and I think what's happening is we all have every single one of us has a million ideas going through our heads every single day. You're sitting there at work, you're typing away at your job, and, maybe it's not your best day at work. You think, I should quit my job, right? And then maybe you think, but what am I going to do for money? I know, I should go rob a bank. And then you start thinking a little deeper and your mind wanders more and you think, maybe I'm a woman. Right? And then you're driving home and you're like, that guy just cut me off as a jerk. I should kill him. Right? So all these ideas pass through your head. You don't fund most of the time we don't fund these ideas. We don't entertain them. We say, oh no, that's a stupid idea. I shouldn't quit my job. I shouldn't go rob a bank. I'm not really a woman. And that guy was a jerk for cutting me off, but it would be a massive overreaction to kill him. Right? So the universe of bad ideas is much, much, much larger than the universe of good ideas, right? For every good idea I have a million bad ideas. And usually my brain is sharp enough to cut me off. And if not, my wife is an excellent backup who will say, no, that was a bad idea. Stop that immediately, right? So we discard most of ideas out of hand as bad ideas, and we fund the good ideas with our time and further attention. And part of what we use to determine if an idea is a good idea or a bad idea is the price matrix. We say, what will this cost me, right? if I want to go buy a Porsche, I've always wanted a Porsche, right? Not really, but say I always wanted a Porsche. Well, what would it cost me to go buy? Well, then I can't send my son to school or to college, right? That's going to be his college education. So I say, well, you know what? It's more important that I send my son to college than I get the Porsche. So you make those decisions based on the price matrix. Inflation distorts the price matrix because inflation causes money to be sloshing around everywhere, derivatives of money. And because these ideas are sloshing, because the money is sloshing around everywhere, more and more and more ideas are being funded. And since most ideas are bad ideas, many more bad ideas get funded than what would be before. Now, I don't think there's nothing in my mind that thinks that good ideas are being punished, but I just think all ideas are being funded more than they would be, and most of them are bad ideas. So that's what's causing us to. That's what's causing societal degradation. And let me give a hypothetical example. So imagine you're a venture capitalist, Dunnigan, and I'm a tech startup guy, and I come to you and I say, Dunnigan, I want to create a website and I need funding, and we're going to call this website hotneighbordaughter.com. So we're gonna have a website where men can rate the physical attractiveness of their neighbors' teenage daughters. Now, you on a gold standard, you would say, Phil, that's a terrible idea. I'm going to be sued, and you're going to be dragged through the streets by angry fathers. But I'm not funding this, right? I'm not going to take this hard-earned gold that we've earned over time through prudence and wise savings. I'm not throwing this idea at that. I'm not throwing this money at this bad idea. But on an inflationary standard, the money is just sloshing around, and you as a venture capitalist, you're looking for yields. So what do you say? You say, I don't know, let's try it, see if it works, right? So the idea gets funding, and you go from there, right? But all these bad ideas get funded. So the relentless search for yields is preventing the other side of this is the relentless search for yields is preventing people from saving. You cannot save in an inflating currency. If you have $100 bill and you just tuck it away in your drawer for a rainy day, when the rainy day comes, it doesn't buy what it did back when the sun was shining, several months ago. So because you cannot save, young men are unable to save to attract mates, right? You hear this from all the young men now, right? I'm in a dead-end job. I'm working at, a Best Buy or a glasses store in the mall. My savings evaporate in front of me. Girls think I'm a total loser. I can't even take them out. The best I could do is take them out for coffee or a Wendy's. So I can't attract a mate. So I'm just going to go, whatever savings I have, I'm going to go have a cruel mockery of a relationship on OnlyFans. Right. And young women, because these young men are unable to save to attract mates, the young women, there are some men who are standing closer to the money printer than others. And those young men are very successful because they're standing next to the inflation machine. So the young women are throwing themselves at the men with the inflation machine, and they're looking for opportunities to make a quick buck because they are but in doing so, and I have to warn every young woman out there, you are destroying your future attempts to find a suitable mate as well, because you are quite literally not saving your virtue. People, the wisdom we used to give to young men and young women was save yourself, save your virtue. That is physical savings. You actually are saving something. When you just throw it away out there, you are no longer saving it, and you are, the human body inflates as well, I guess we can put it that way. So the discipline required to save in any form, whether you're saving money, whether you're saving, yourself and your virtue and, building yourself up to be a better person, it breaks down and society becomes hedonistic and ultimately quite feral, right? Everyone's just sort of, it just descends into complete chaos. So the good news that I want to leave people is the bust quickly restores reality, and savings are once again encouraged, and then prosperity can be rebuilt. People from what I can judge from history, people, put away the photos of them acting like complete lunatics, and we just pretend it never happened. And you get your tattoos removed, and you go back to, women wear a dress, men wear a shirt and tie again, and we go back to, prudent and resourceful living and modestly again as well. So the insanity will break. We're not doomed to this. It's just a function of the inflation.
It's interesting, your connection that you're making, and is one that Rafi makes as well, between inflation or destruction of the money and immorality. It's also noteworthy that the Bible mentions the pitfalls of debting, for example, or dishonest money, and depriving the worker of their wages and that sort of thing, more than it does any other single crime against justice and against humanity. So it's something that is part of the infallible wisdom that we've been handed. Should we choose to ignore it, it's at our own peril. Phil, for people who want to follow your lively explanations of what might otherwise be dauntingly complex concepts in a very accessible way, how shall they find you? We can put a link to your Rumble channel in the description of this video, but just encourage people how they can make sure that they don't miss any of your work.
Sure. So you can find me on Rumble at the Bitter Draught. You can find me on YouTube, but I prefer everyone use Rumble. It's also at the Bitter Draught on YouTube. You can find me on X at the Bitter Draught, and you can email me at thebitterdraught@gmail.com. One word.
And again, folks, that's Bitter Draught spelled D-R-A-U-G-H-T, the traditional spelling, meaning it's a bitter sip, but it'll as Stephen Covey said, once you swallow that bitter pill of responsibility, it makes all things possible. And if you refuse to, nothing's possible. So we're grateful for your presence here, Phil, and grateful that Rafi Farber introduced us, and we look forward to future visits with you here as well. Folks, check out the description of this video for a link on how to find Phil on Rumble. And if you don't want to miss a single episode with Phil or any of our other guests, make sure you're on our free mailing list by going to our website, libertyandfinance.com. Just go to libertyandfinance.com, put in your email address, click submit. Make sure you confirm on the confirming email. You'll get one email in your inbox per day. We do not share your email address with anyone. It's completely private and it's completely free. You'll get all of our latest interviews, including every interview with Phil and all of our other guests, and you'll get our weekly specials there as well, so you'll never miss a thing at libertyandfinance.com. So, Phil Lowe, founder of The Bitter Draught on Rumble, thank you for joining us again here on Liberty and Finance.
Thanks, Dunnigan. Take care.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for March 10th through March 17th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold Krugerrand at just $59 over spot. Next, Valcambi silver kilo bars are just $2.20 over spot per ounce. Pre-65 mixed junk silver is just $1.99 over spot, and pre-65 half dollars are just $2.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.